In this video, I'm going to show you why you don't have a trading psychology problem. Listen, if you're new, if you're a beginner, or if you've been trading even for 3, 4, 5 years, but you haven't gotten to consistently profitable yet, I'm about to show you why you don't have a trading psychology problem. So here's where I think the trading psychology conversation comes from. It comes from a really great book, Trading in the Zone. Trading in the Zone is about how to develop market intuition. So it's not a trading psychology book per se, but when you develop market intuition, one of the things, the most common things that pop you out of the zone or market intuition is trading psychology issues. Here's the thing, that is not a beginner subject. In fact, in Trading in the Zone, Mark Douglas, the author, he lists off the 3 steps that most traders roughly progress towards market intuition. The second step is just an intermediate phase where you're starting to become more aware of what it feels like to have market intuition. And of course, the third step is actually getting to market intuition, where you can just look at the charts and you start to see setups and you just take them and it works out for you. What's the first step? The first step is mechanical trading. And if you're a beginner or you haven't gotten to consistently profitable yet, that's the phase of trading you're in. So what's mechanical? If you're not familiar with it, it's basically doing the process of back testing and forward testing to develop a statistical edge on the strategy that you're trading. So you know that there's a criteria. If you hit certain moving average or whatever it is that you're looking at, that is your entry criteria. And you've done the statistical analysis to know that if you get in there, more often than not, probabilistically, the trade is going to go in your favor. Then you have a second criteria that is your exit criteria. And you've done the work to probabilistically know that you should wait for that exit criteria. And if you take your trade there, you've got all sorts of analytics that tell you what this strategy is going to do. And you just mechanically enter when you see the criteria to enter, and you mechanically exit when you see the criteria to exit. It's not the perfect way to learn how to trade, but it is the training ground that your mind and your subconscious need to develop intuition eventually down the road. Certainly not as a beginner. So let me pull up some charts and I want to explain to you exactly uh, how you don't have a trading psychology problem here. We're going to discuss the basic things like FOMO and hesitation and chasing and what you'd perceive to be a lack of discipline in yourself. Okay, just as an example here, I've pulled up the NASDAQ 100 futures. So let's go ahead and look at today here. We're going to use the opening range breakout strategy as an example. Most people are familiar with this strategy, but if you're not, the idea is that you simply take the first 15-minute candle of the day and you put a support and a resistance line at the top. And when the price breaks out below or above that line, then that's an entry and it should go higher. Okay, let's go to a 1-minute chart and let's see how this played out. I mean, you've seen now already on the daily chart or on the 15-minute chart how this plays out, but let's see at the open how this plays out. So this is where you're at. You are at 940, 945, 946, somewhere in there. It's starting to break above that line. And now you're starting to develop some fear and some anxiety. And you think that's FOMO because you're afraid of missing out. Here's the thing. You went and looked up this strategy from someone on YouTube and they gave you the criteria, and maybe people talked about it on Reddit or X or wherever it is that you're on. And so you kind of have an understanding of this strategy, and that's good. But you don't really. because you haven't seen the strategy play out literally hundreds of times. You don't know what is common, what is usual. So the first time you trade this strategy, you're all excited. You just pop in here, no problem. You have no issues with that. And it kind of goes in your direction. Maybe you take profits here. Maybe that's not enough risk to reward because you want 1 to 2 risk to reward on this. That's what you're looking for. You want to leave it. So you leave it and you leave it and you leave it. And it kind of chops around for most of the day. And then it stops you out. So now, was that a lack of discipline? Was it chasing, or should you have taken your profits? See, here's what my point is. It's uncertainty. A lot of the emotions that you're experiencing in trading are uncertainty, and it creates fear. And what your subconscious does with uncertainty is it errs on the side of caution. So when it sees something like this, it starts to send out like panic signals, and you maybe start to get into like some hormones like cortisol and adrenaline. But when those hormones come into play, then your subconscious really starts to think, man, we're in danger. And those, because you're just sitting here at the computer and you're watching every tick go by, those emotions don't have the opportunity to just get cleared out of your body because they get cleared out when your body moves. But you're not moving. You're just sitting here building up more and more of those hormones, which create more and more emotion. And then you're saying all sorts of things like I was on discipline. Here's the basic fact is you don't know. You didn't know this was going to spike up. You didn't know you weren't going to get 1 to 2 risk to reward on this. You didn't know you should have taken profits there. When you're new at something, you just don't know, and that's okay. But you need to admit it to yourself. You need to admit, I'm new at this. Someone else has told me this, but I don't know yet because I need to look into this strategy more. I need to see 100 or 200 occurrences of this strategy playing out, and not even just in a back test to see how it played out. You need to actually be trading this and experiencing it live. Now, the reason for the mechanical approach that Mark Douglas talks about is to take the emotion away because you're no longer making a decision. You've done the work to see that a strategy has a mechanical or statistical edge, and now you're going to mechanically trade it. So there's no emotion because there's no decision. Your entry criteria comes, you just take the trade. Your exit criteria comes, you just exit the trade. And if something's not working out over 10 or 20 trades, then you're going to go back and see what happened. But in the moment, you're in no position to decide that, right? Because we talked about maybe like hormones are really running through your body because you're watching this and it's all new and you're nervous. Okay, let's move on. So you got stopped out, and the classic thing that happens that everybody complains about, total classic thing, got stopped out, it went back, and then the move eventually spiked up, and you would have had a big winner. But you got stopped out here. So now you're thinking, oh, I was undisciplined, or I chased, or I hesitated. No, you didn't do any of those things. The trick here is that you need to develop a statistical edge and trade that mechanically. And over time, as you get more market experience, your subconscious sees all of this information being organized in a spreadsheet. And your subconscious can start to put this together and it can start to develop intuition in the markets. Okay, now let's talk about what I referred to as beginner psychology. See, now I've just shown you how things like FOMO and chasing and whatnot are not, that's not really the way it works. What you're really dealing with is uncertainty. So, number one beginner psychology thing where you need to start is you need to get used to the idea of probabilistic outcomes. You see, we're used to, like, say, driving a car and you come to a red light and everybody stops. There really isn't a whole lot of probability in there unless you want to factor in the 1 in a million times when somebody runs that red light. But for the most part, we're used to things just happening in a certain way, fairly expected. Trading doesn't work that way. You might win 30, 40% of the time. You might win 50%. You might win 60%. If you're a scalper, you'll win 90%, but no one wins 100% of the time. And you need to get used to that idea. Now you understand that logically, but as I mentioned, your subconscious needs to get used to the idea that it's okay for some trades to not work out and you will still make money over 20, 30, 50, 100 trades. And it's only going to be able to get used to that by experiencing it, but you're going to be able to help it by organizing that data into a spreadsheet, reviewing it, and showing it exactly the way things worked out. Another beginner psychology thing is you just want to work hard at this. You show up every day at the markets and you're there at like 7 o'clock in the morning and you watch it till like 10 o'clock or noon, or some people till 5 o'clock after the market close, and you watch every single tick. Guys, no one does this. The most experienced traders could not psychologically watch every single tick that happens on a 1 minute chart or a 5 minute chart. No one does this. The best traders I know, they go shopping during trading hours. They play video games during trading hours. I'm not making this up, by the way. This is real things that traders do to try to not watch the chart the whole time because it doesn't help you. No one can do that. Now, there is a caveat to that. If you're a scalper, then yeah, you're probably doing that. How do you know if you're a scalper? Because they like doing it. They're lit up by it. They're excited. They're happy. They're doing it. But for most of the people, they're not. Most of the best traders do not watch every tick go by. Another one that you might be familiar with is you need to find a style that works for you on a time frame that works for you. So most traders show up thinking that the only way to make money is to be a day trader or a scalper. That is absolutely not true. The best traders like Paul Tudor Jones and Soros and Druckenmiller and all of those legends were not day traders. They were swing traders and position traders. And of course, the person who made the most money in the stock market was Warren Buffett, and he's an investor. You absolutely do not need to be a day trader, and it's okay to be a day trader. My point is that if day trading doesn't align for you personally, if it's not working for you, you really need to be open to swing trading or some other time frame, some other style, because there's something out there that's going to work really, really well for you. And if day trading is not working for you, then you're not going to make money at it. And it doesn't have to be the most profitable way to trade. That is a misnomer. That's not necessarily true. I'm not going to spend a bunch of time going over all of the beginner trading psychology issues. These are kind of the main points. But what I really want you to take out of this is that if you're doing this wrong, you're hurting yourself. Because if you're getting into trades and you're feeling really bad or you're feeling really hesitant or you're blaming yourself after about your trading psychology, when it's more maybe an issue that you need to understand the setup better and develop edge on it for yourself, if you're constantly having those bad moments in trading where you feel bad, your subconscious is now storing that. So what you want your subconscious to store is neutral or even slightly happy trades where you have a statistical edge and you're operating mechanically and there isn't a lot of emotion there. Or maybe there's slightly a little bit of happiness because you have a strategy that's working for you and you just go ahead and execute on it. So that's what you want your subconscious to store. But if you're doing it the typical way that I see most traders do it, where they're beating themselves up about their trading, then what your subconscious is storing is just negative experiences, negative memories that build up over time and cause your psychology to eventually continue to get worse and worse and worse until eventually most traders give up. So I want you to take that away. You need to have structure to get your psychology straight. If this resonated for you at all, please leave a comment and I look forward to seeing you in the next one.